It's been an absolute dismal year for stocks. We have some of the worst performance we've seen in over 52 years. Obviously, there's so many different events that are happening right now, whether it's the central banks tightening the money supply or it's the war that's going on in the Ukraine. There are several different factors right now that are leading to this uncertainty, but we're going to go over and discuss maybe some areas of the past of when the market has performed so bad, what happens in the second half, and I'll really look to what your thoughts and opinions are in terms of, are you bullish or are you bearish from here? And I'll share my thoughts at the end. But if this is your first time, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, ask if you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. We have all been living through the pain that is the stock market. I know I felt it in my portfolio. We've seen the tech stocks started falling off in November of last year, and now it seems like bonds, gold, even oil has taken a little bit of a hit in the past couple weeks. It just seems like there's destruction everywhere. And the last time that we saw this destruction was in 1970. So let's take a look at this Bloomberg article here. And we see that the S&P 500 is down 21% since the beginning of the year, amid expectations, a mix of high inflation, a hawkish Fed, and potentially a looming recession. The last time it was there, the 70s. The 70s we've talked about in numerous amounts of time. We covered a video about stagflation, so I will link that above. And that is definitely the fear right now, is that we are going into a period where we are raising the interest rate. We're going to slow the economy, but the inflation rate is continuing to go higher, coupled with higher oil prices. So we can see here, this chart shows an indication of the performance of 1970 in the first half of the year, and it's exactly the same as where we're at. It is a very bad first half of the year. And we can see some of the other first half performances on this chart just for reference. Every single year is not going to be a great year. We have covered this many times before. The S&P 500 does about 8 to 9% annualized, but you have to stay invested for the long run. You can't be in and out and trade and time the market. We've covered that one before. It does not lead to any success. So we will take a look at this other article that I found here, and it says that the S&P lost 21%, like we said, and that was during a similar type of economic situation. But if we look at the chart here, it rebounded. It rebounded in 1970, and it did about 26% in the second half of the year. So we're sitting at a situation right now where we're kind of dealing with all the same things that they dealt with in a similar fashion. I mean, past performance is not a predictor of future performance. We know that. But it kind of seems like how much more damage in the market can we have? Should we be bullish from here? Well, Michael Burry, who is the well-known person known for shorting mortgage-backed securities back in 2008. They made a movie about him, The Big Short. If you haven't seen that, go check that out. Super bearish still about the economy. So let's take a peek about what he says. He says that we may be about halfway through the market fall. And to get into more specifics, let's take a closer look as to what he actually said. Well, we see adjusted for inflation, he's factoring in the 6, 7, 8% inflation that we have. The S&P is down 25 to 26 points. We have the Nasdaq down 34 to 35, Bitcoin 65, etc. He's saying that that was multiple compression. Next is earnings compression, so halfway there. So he thinks there could be another 20% downside to the S&P as it stands, but if you're factoring in inflation, add double the numbers that are listed on the screen. So Michael Burry is saying more capitulation to come, whereas the market in 1970 showed that the halfway point was an inflection to higher. So it's definitely a point in time where you have to sit back and kind of put it all to the side. And I guess this is where my thoughts come into play. And my thoughts are that at any time, if you have a long horizon, anytime that you see the market down 1 or 2% in a day, you should be nibbling away. You should be putting some cash that you've built up, whether those are dividends that you've accumulated or some cash that you don't mind putting into the market for 5 or 10 years, and you don't need in the short run. You should be nibbling and buying away at an S&P 500 index fund. We have covered that before, so go check out that video to learn more about that. It does about 7, 8, 9% a year compounded over the long run. You need to hold these things and have a long-term vision. Could stocks potentially go down halfway more, like Michael Burry saying? Yes, for sure. But the money that is invested in the market, we know that we don't need on a short run basis. And we know over the long run, 5, 10, 20 years, 20 years plus, that you will eventually, the market will bounce back and those will turn to positive returns. So that's my 2 cents. That's my opinion on the matter. That's the personal way that I'm dealing with this current volatility is I'm just nibbling away. And you can check out the stocks that I'm buying on my Instagram just to get a feel for, the right type of psychological time to buy, buy when others are fearful. That's obviously a Warren Buffett quote. So take advantage of the opportunities that are being presented. I try and provide some context, so I will provide my Instagram down in the description below. But I hope you all have a great week in the market. Stay calm, stay cool, don't panic.